Welcome to this video, created from a live broadcast which took place on June the 28th, covering the economics of collateral management and how to make a profit. This part 1 covers the background to cash as collateral, regulatory and market initiatives, fragmentation of the OTC market, the uncleared margin regulations, and a poll on how familiar people are with the uncleared margin rules. Our speakers today are Ted Allen, Director of Business Development at FIS, John Lunt, an independent consultant, and Eric Bystrom, who works in the front office on collateral optimisation at Commerzbank. We hope you enjoy the video.
Well, thanks, Bill. So as you said, yeah, I've been involved in collateral management for many years now. I started off in the mid-90s making collateral calls on ISDA CSAs for one of the larger American investment banks. Things potted along in a very dull way without really changing for many years. It all got exciting a few years ago with the after the crash, and now in my role as business development within FIS, so we're a provider of software and services around many aspects of finance. Of course, I'm particularly focusing on securities financing and collateral management. So I spend a lot of my time talking with market participants and our clients around what are the various constraints that they're operating under, what are the various priorities that they have. And what is clear right now is that any kind of initiative within firms in this sector these days is going to be driven by regulations, there are many different strands of regulations to keep track of and remain compliant with, and try to minimise the impact of. So we have, for example, the regulations coming under EMIR and Dodd-Frank in the US and various other equivalent global regulations that have completely changed the OTC derivatives market, and a vast portion of that market has now moved to the centrally cleared model, which has created a whole load of operational complexity and the economic impact of the extra amount of collateral that requires. Next up, we'll have the rules that will supplement the clearing mandate, and that is the rules around the margining of those trades that remain non-cleared. Likewise, those rules will also require a whole load of operational change and a significant impact on the amount of collateral that's required to support an equivalent level of business. So there's those strands. And then we have Basel III and the capital requirements that are increasing, which has the similar effect of increasing the demand for high quality liquid assets, and creates more focus on balance sheet usage. There are other regulations that will be coming in, like the securities finance transaction reporting, which is again going to require not just the reporting of the transactions similar to the derivatives that are already reported, but also will create restrictions on the rehypothecation of assets and put further constraints on the available supply. So I guess I'd boil it down to two sets of problems. One of problems concerned with the operational complexity and being compliant and remaining compliant, and then secondly the economic impact of the extra collateral that's required, and how do you minimise or mitigate that particular impact.
If you want to comment on
I suppose just to make one observation, that this year and next year it seems that a lot of these regulations are coming together, and just speaking, for example, from a Category 2 asset manager, May the 21st was the clearing date, which has really accelerated the trend towards clearing. And then we know that uncleared is coming up shortly, and then following shortly behind that, MiFID II, PRIPS, indirectly the impacts on Basel III. So I'd say that after many years of waiting, now is the time when these regulations are converging, and really the challenge is to appreciate the intersect between how those regulations overlap and how to react to those different challenges coming from the different regulations. And in some cases, the conflicting demands of the different regulations, which is quite interesting to deal with that challenge.
Yeah, and maybe I'm just, just get a little bit of perspective from, I think, the sell side and the banks, looking at really the economics behind collateral management. I think what's really interesting is looking at, as you mentioned earlier, collateral management wasn't in the forefront of most banks until the crisis in 2008. And what was particularly interesting then was to see that, most collateral was cash. And I think what happened then was there was this realization of how expensive it was to actually post cash as collateral, as opposed to lower grade assets such as government bonds or whatever else was eligible under the collateral obligations. But interestingly, there was this disconnect of the front office being able to quantify what the additional cost of posting cash was, and operationally actually being able to post non-cash collateral. And I think that's something that the industry has really been looking at. How do we work towards bridging the gap there, and how do we really work in terms of allowing collateral to flow more freely in the system, and actually being able to post what is effectively the most optimal to post. And then I think you mentioned it also as well here with the new regulations coming in, with the much more looking at the capital implications of doing some of those traditional collateral upgrade trades, the repo market and what have you, where obviously it's more expensive now to be doing those upgrade trades, and really yielding the economic benefit that used to be available in the sort of cheapest to deliver market. So I think from a bank's perspective, it's really interesting to coming back to this comment, is cash still king? Well, I think it never really was king. It just came to the forefront that there wasn't really the infrastructure in place to be able to freely move collateral around the system as efficiently, and I think that's where a lot of the the initiatives have been and still will need to be going forward.
So we've got the uncleared margin rules coming up, and Ted, you've got a slide here sort of summarising what appear to be some Titanic impacts from these new rules.
It's a Titanic indeed. So this is, I guess there is a general consensus around these numbers or numbers similar to these. That is that these upcoming rules, when they do come in, I guess we'll talk about when they do come in, it will likely have an increase of something like 5 times the number of margin calls that will need to be processed, and that's because there will be a number of portfolios run in parallel. There'll be legacy trades that fall under existing collateral agreements, and then there will be new trades that post the regulatory cutover will come under the new regulatory collateral agreements. They'll be margined separately, and depending on the size of the outstanding derivatives book that a firm would have, they may also have to exchange IM or initial margin bilaterally with their counterparties as well. So the combination of the fact that margining is going to become mandatory pretty much for the majority of users of derivatives, and the fact that one margin call is now going to be transformed into multiple margin calls. We're looking at something like 5 times as many overall. The number of substitutions there, we think might be something like 10 times. And that is likely as a result of the increased mobilization of non-cash collateral and a more active management of the collateral portfolio. So what assets are posted out, and trying to remain or achieve an optimal state and remain in an optimal state of how the collateral is allocated as much as possible. That's going to drive an increase in the velocity of collateral, together with the various market infrastructure changes that Eric alluded to, which would allow that. So those are kind of operational challenges, and then we've got the extra amount of collateral. Maybe it's $800 billion. I think that number came from the Bank of England quantitative impact study, but it will be of some kind of order not dissimilar to that, I should imagine. So yeah, quite a titanic impact.
So I was going to say, we've got a couple of slides coming up, one for John to talk about the evolution of the segments of the market, and the other one about the timing of the uncleared margin rules. So let's move on to that. And maybe John, you could talk us through this virtual slide. I took off the word notional because I felt it may actually be too specific. What it is more a virtual view of how the market may fragment, but maybe you want to take us through the 5 categories and explain why these are going to change.
Absolutely. So this is, as Bill mentioned, is a virtual prediction as to how a typical buy-side book might evolve over the next 2, 3, 4 years. And at the moment, it's nice and straightforward. There's bilateral CSAs, which is the red section. So with 10, 11, 12 counterparties or so a fund might easily transact just with those counterparties on a bilateral basis, which is section 1. And then the first change would be the move to clearing. So we know category 2 asset managers have started to shift across some of their derivatives book to clearing, which is category 3, the green section. And again, this is an indication that actual speed would vary by participant. It's really to illustrate how it would fragment into these different components. And then moving along, probably the next, I've changed around a little bit, but moving along, the next bar is the blue section at the bottom. So we know from March of next year, probably later now with the delay in the European regulations, any new bilateral trade will fall under the new bilateral CSAs. So that has operational and technology implications. Those CSAs will have different eligibility of collateral and different operational implications. So they have to be treated differently. So there we've got 3 sections. And then we start to get on to more the elective or the kind of the options that participants might have. And clearing, it's not simply a case of just being compliant with the clearing rules. Participants have a real choice, and they could, for example, elect to clear Aussie dollar swaps, even though they're not mandated, or inflation swaps, or longer dated Nordic currencies. So they have a real choice, which is, do I leave it bilateral, or do I clear those other swaps? And that's where we start to look at more sophisticated tool sets to assess IM numbers, do I clear or do I not?
So what would go into that decision around whether you clear or not to clear? I guess from the buy side and the sell side might be different.
Just from the buy side, it would very much be weighing up, if I leave it bilateral, the new rules would carry additional cost to leaving it bilateral, and the execution cost from the sell side may well increase. The expectation is that the execution cost will increase, although it hasn't yet. So that's kind of the stick. And then the carrot is, if I move it to clearing, I may well get offsets with the existing book I already have in a cleared world. So there's not one factor, there's several factors that need to be weighed up, and then I haven't mentioned other factors such as CM costs, CCP costs. So you need to consider a number of factors to make that determination. Mm-hmm. And once we move down this path, the materiality of these numbers could start to get quite significant, several hundred million IM. So it's kind of worth making an informed choice using the appropriate tool set to make that choice, because it could have a real difference as to the cost of running a derivatives book.
Yeah, I'd agree with that. I mean, I think a large part of this is going to be determined of how efficient the sell side of the banks are to actually price in, the advantages of clearing versus non-clearing, and how big is the differential going to be for the actual practitioners on the buy side. I mean, is the incentive going to be there for the buy side to really adopt clearing, electively, even if they don't, it's not mandatory necessarily, but how quickly is that going to happen, I think will depend on, what is the incentive and how quickly does the sell side actually move to price in all those costs. So I think the interesting, on your graph here, John, I think the interesting question here will really be the difference there of how quickly does that elective clearing really kick off, and how large of the pie is it really gonna be going forward based off of that.
Yeah.
And are we seeing material differences now in the pricing of the trades, if they are cleared or non-cleared?
Not. I think there's, from what I've heard and seen, there's an expectation that it is coming, but actually right now I don't think there's a huge difference in prices. But there's an expectation over the next 6-12 months that will start to diverge.
Yeah, and the feedback we've been hearing a lot from our clients as well is it depends on how advanced each institution is on the sell side, right? Some sell side institutions are a lot more efficient in passing back, all their costs to, the execution desks, and they will therefore have a better, mechanism of pricing in some of those costs to the end clients. Whereas others aren't advanced, and these costs are therefore not being passed back to the front office, and therefore not being priced into the actual trades themselves. And so, I think again it comes back to that question of how quickly is the market going to move towards that, and really starting to see a two-tiered pricing market.
What I think would be interesting is the sort of later categories, the pension funds or category 3 guys who do not have to clear for a couple of years. But what will be interesting is if this price discrepancy will kind of overtake that exemption, and it will force them to clear and make the exemption worthless in some cases. So it would be interesting to observe how that evolves.
I was going to say, we already know there's a price difference between CME and LCH swaps for economic reasons. There's various slides you can find out about that. So it will be reasonable to expect that as you introduce new margin rules in markets, you should see the costs of the margin reflect in the price at the market. We shall see.
So the difference in the price between LCH and CME is driven by the types of collateral that they'll accept, or the IM calculation?
The analysis I've seen is a lot to do with the directionality of the trades at CME are often buy-side trades paying fixed, and that skews the way the margin gets calculated by CME. Means that margin costs are different because of the directionality of the portfolio. It doesn't necessarily the underlying assets. If you go look on the Clarus FT website and various other places, they've got a much more detailed analysis of why there may be, or there is, a basis difference in the price between CME and LCH for the same swaps. CME put out a PowerPoint that's about a year ago, actually, explaining their views on why it is the way it is. But anyway, that's secondary to discussion. Anyway. Why don't we go on to the uncleared margin rules? Because there's stuff happening there. I don't know which one of us wants to cover it. Or I can cover it. Okay. Well, I'll put the slide here. Yeah. Anyway, so for anybody who doesn't know, only in the past couple of weeks, it's more or less factually been revealed from the European Commission that they aren't going to be reviewing the proposed European but uncleared bilateral margin rules at least till the end of this year. So in theory, according to one of their spokespeople, they won't be requiring the Wave 1 banks, that is, the people who would be doing IM and VM in September, they won't be requiring them to comply until mid-next year. This is an anecdotal, this is not firm, but that's their indications. And you can see on the slide there's coverage at Bloomberg and IFL if you want more background. So I also noticed today the ISDA put out a briefing saying this is all very unfair and quite bad because it means that an American firm or a non-European firm who is subject to rules starting in September have to pay and receive IM, whereas their counterparts may not have to pay it, can quite happily receive it. I saw another comment from ISDA that said potentially firms trading with American counterparts may still be required by Europe to cooperate with the American rules and do two-way posting. But it's a bit like Brexit, it's not very clear exactly what's going to happen, but all you can conclude is that if the timing of the rollout of the bilateral margin rules is different around the world, it's definitely going to cause a certain amount of economic chaos for people who do and don't. So, unless there's any other comment on this.
Well, I guess we've seen the US and Japan both saying they're going to go ahead with the original timescale of September this year for the first wave and March next year for the second wave. But Whether that really happens because of the disadvantage that I guess the US banks, the Japanese banks would be under. Why would you trade with them if you've got an alternative where you don't have the margin costs? So maybe that won't happen. There are other markets to consider as well. I don't know what's happening in Canada, for example, or South Africa, or Singapore, or and so forth. We can who are also implementing the similar regulations. I think we can imagine that those rules may well be delayed as well. I don't know what kind of preparations are happening in your firms around.
I mean, the asset managers I'm speaking with are, right now the focus had been on clearing with the 21st of May date, so it's only now that the attention had been starting to shift to the uncleared rules, and this delay may delay the preparation to some extent, although I would say for global asset managers, even if they're largely focused on Europe, if they do have US funds, then as you mentioned, Ted, they'll still have to conform with the US rules. So now is the time when the buy side is really starting to look at this with the VM. I think the expectation is that the IM rules will be 2018, 2019, so it's very much the focus is on conforming to the VM rules, and the other important aspect is the operational part of it that they would need to comply with, not only the operations changes themselves, but also the procedures which need to be documented to conform with the rules, which is an interesting aspect. So that will be the focus, I think, for the majority of the buy side for the next 6 months. The VM and then IM will follow at a later date.
Yeah. No, I mean, I was just going to add, I think for the sell side, clearing has been around for long enough now that I think, the market is prepared for it. And you were mentioning on the buy side that's, really something that's on the top of their mind right now. I think on the sell side, clearing is certainly something we've been waiting for. We're ready for it. But when it comes to the uncleared bilateral margin rules, again, even if it's delayed by a year, I think it's certainly been one of those topics which has been on the forefront of the regulatory agenda, and therefore something that's been worked on, and implementation will continue as planned, albeit the timelines may shift a little bit. I think coming back to Bill's point, what will be interesting to follow more is what happens in the execution markets, i.e. is there some form of advantage or disadvantage across the globe in terms of Europe behind, and therefore
some regulatory arbitrage.
Well, exactly, or something along those lines, right? But I think in terms of being prepared for it, I think the banks are still very much focused on getting this right and making sure the infrastructure is in place and being able to do that.
Just one final point, maybe. Sorry, just a link in from the previous slide about the transition. The IM thresholds could dictate, well, the speed at which that transition takes place could dictate whether or not a buy-side firm would even have to meet the requirements exchange IM if they fall under the thresholds. So that's why having tools to monitor, the expected pace of transition and the notionals are essential to determine if, or even at all, if buy-side firms even have to meet those IM regulations at all, which is probably unique to the buy side. I guess the sell side is expecting to fully conform with the IM as well as the VM.
Yeah, exactly.
Yeah.
Okay, so this leads us on to the first part of audience interaction. So for those of you who are participating, you should be able to vote in this poll. If you could look at your screens and click to give us a clue as to how well you understand the forthcoming margin rules, no matter which jurisdiction you're in, and we'll have a look. I'll leave it a minute. I can see people are clicking, and I'll then show the results. So basically, do you know it very well? You're sort of familiar? I think you should know more. Really don't. There's 5% of people so far don't understand the question. So we've referred to them as the BCBS IOSCO regulations. In fact, they're written by the CFTC in America, or the European
ESAs.
system of regulators. But the European regulators, of which Britain's currently part of. So it means that wherever you live, probably, there is a new regulation that says for things for OTC business that isn't cleared, you will have to apply variation margin or initial margin at some point in the next 5 years, depending on the size of your portfolio. If you're one of the 4% who don't understand, then we'd be quite happy to follow up afterwards. If you email us, email the OTC space, we can give you some help offline. So we've had 72% people voting. I'm going to, unless anybody wants to vote now, hurry up, and then I'll show the results. All right, so if I do that, that's quite interesting. So a very small number of people are deeply familiar. A good number, 43%, are pretty familiar, but 47% really aren't sure. Interesting. So, what would you suggest for the 47%? Where do they go and get their information? And we can follow up offline and send out some links information, but I mean, what would your immediate thoughts be?
Well, it should read the OTC space, Bill. It's got a raft of information on there.
Apart from us, there must be official sources of this stuff. I mean, it's the CFTC in America, although their website is nearly impossible to follow, but it's there somewhere.
The European RTS, the ESA RTS is a good source of information, and the industry feedback on the RTS is quite insightful to see the direction of travel of the RTS. And it will be interesting to see how much the final version changes from the last version which was issued.
Yeah, and of course, I mean, if you're a practitioner in the OTC derivatives market, you know, you can always, you know, go to your clearing brokers or your, you know, security service firms, and they should be able to guide you in the right direction as well. I mean, I do think it's important, you know, even on the buy side, to get familiar with this, because, you know, we might be talking about it in a while, but, you know, the big question is, to what extent, you know, do you need to start to adapt to, you know, this new reality of, you know, the derivatives market changing, but also, you know, how do you need to set yourself up in being able to manage this, you know, additional margin requirement that's coming your way.
So we